Hello everyone, welcome to BUS 327. This week we're going to be talking about capital budgeting. First is capital budgeting. It is the process of evaluating and selecting long-term investments that are consistent with the firm's goal of maximizing owner wealth. Second, a capital expenditure is an outlay of funds by the firm that is expected to produce benefits over a period of time greater than 1 year. So a capital expenditure is longer term in nature. An operating expenditure is an outlay of funds by the firm resulting in benefits received within 1 year. The steps in the capital budgeting process, there are 5. First is proposal generation, where proposals for new investment projects are made at all levels within a business organization and they are reviewed by finance personnel. And then review and analysis. Financial managers perform a formal review and analysis to assess the merits of investment proposals. Number 3 is decision making. Firms typically delegate capital expenditure decisions making on the basis of dollar limits. 4th is implementation. Following approval, expenditures are made and projects are implemented. Expenditures for a large project often occurs in phases. And finally, we have follow-up. Results are monitored and actual cost and benefits are compared with those that were expected. Actions may be required if actual outcomes differ from the projected ones. So let's look at an overview of capital budgeting, some basic terminology. So, independent versus mutually exclusive projects. Independent projects, these are projects whose cash flow are unrelated to or independent of one another. The acceptance of one project does not eliminate the others from further consideration. Mutually exclusive projects are projects that compete with one another so that the acceptance of one eliminates from further consideration all other projects that serve a similar function. Unlimited funds versus capital rationing. Unlimited funds is the financial situation in which a firm is able to accept all independent projects that provide an acceptable return. Capital rationing is the financial situation in which a firm has only a fixed number of dollars available for capital expenditures, and numerous projects compete for these dollars. Accept, reject versus ranking approaches. An accept-reject approach is the evaluation of a capital expenditure proposals to determine whether they meet the firm's minimum acceptance criteria. If they meet that criteria, they're accepted. If they don't meet that criteria, they're rejected. A ranking approach is the ranking of capital expenditure projects on the basis of some predetermined measure, such as the rate of return. The payback period, or the payback method, is the amount of time required for a firm to recover its initial investment in a project, and it's calculated from cash flows. The length of the maximum acceptable payback period is determined by management. So if the payback period is less than the maximum accepted payback period, then you would accept the project. But if the payback period is greater than the maximum acceptable payback period, then you would reject the project. Some pros and cons of payback analysis. The payback method, it's widely used by large firms to evaluate small projects and by small firms to evaluate most projects. Its popularity results from the computational simplicity and its intuitive appeal. So it's very simple to compute and it's intuitive. If you know that you're getting your money back in a couple of years, that can help you to make the decision. And it's often a starting point as well. So by measuring how quickly the firm recovers its initial investment, the payback period also gives implicit consideration to the timing of cash flows and therefore to the time value of money. Because it can be viewed as a measure of risk exposure, many firms use the payback period as a decision criteria or as a supplement to other decision techniques. The major weakness of the payback period is that the appropriate payback period is just subjectively determined, and so, it's a subjective idea. It cannot be specified in light of the wealth maximization goal because it's not based on discounting cash flows to determine whether it adds value to the firm. A second weakness is that the approach fails to fully take into account the time factor in the value of money. And third, the weakness of the payback is its failure to recognize cash flows that occur after the payback period. The next method is the net present value method. This is a sophisticated capital budgeting technique. It's found by subtracting a project's initial investment from the present value of its cash inflows, discounted at a rate equal to the firm's cost of capital. So net present value is equal to the present value of cash inflows minus the initial investment. The decision criteria is that if the NPV is greater than 0, you accept the project. If the NPV is less than 0, you would reject the project. If the NPV is greater than 0, this means that the firm is going to earn a greater return than its cost of capital. And that type of action should increase the market value of the firm and the wealth of its owners by an amount equal to the NPV. The internal rate of return is the discount rate that equates the NPV of the investment opportunity with 0, because the present value of cash inflows equals the initial investment. So it's the rate of return that the firm will earn if it invests in the project and receives the given cash flow. So it's the internal rate of return. The decision criteria is that if the IRR is greater than the cost of capital, then you would accept the project. If the IRR is less than the cost of capital, you would reject the project. These criteria guarantee that the firm will earn at least their required return. That type of outcome should increase the market value of the firm and therefore the wealth of its owners. Finally, comparing NPV and IRR techniques, which approach is better? So on a purely theoretical basis, NPV is the better approach because it measures how much wealth the project creates or destroys if the NPV is negative for shareholders. Certain mathematical properties may cause a project to have multiple IRRs, more than one IRR resulting from a capital budgeting project with a non-conventional cash flow pattern. The maximum number of IRRs for a project is equal to the number of sign changes in its cash flow. So despite the theoretical superiority, financial managers prefer to use the IRR approach just as often as the NPV method because of the preference for rates of return. So in reality, they probably use all three, the payback method, the IRR, and the NPV, and then look at each of those to help them make a decision about which investment project to choose. I hope this helps. I will see you all in the discussion.